Have you ever wondered how some people build wealth effortlessly while others struggle? The secret weapon available to everyone is compounding. It's the closest thing to magic in finance, capable of exploding your net worth. Compounding isn't about getting rich quick. It's about making smart decisions today for massive success down the road. In today's video, we'll break down what compounding is, how it works, and the steps you can take to harness its power. Let's dive in. Alright, let's get down to business. Today we're diving into the fascinating world of compounding. Compounding is the process of earning interest on your interest. It's a powerful financial concept that can significantly grow your wealth over time. It's like a snowball effect for your money. As your initial investment earns returns, those returns start earning returns too. Imagine you invest $1,000 in a low-cost index fund that tracks the S&P 500. This is a common strategy for many investors. Historically, the S&P 500 has returned an average of around 10% per year. This means your money could grow significantly over time. After the first year, your $1,000 investment grows to $1,100. That's a 10% return. In year 2, you're earning a 10% return on the entire $1,100. This is where compounding starts to show its magic. At the end of year 2, you'll have $1,210. Your returns are now earning returns. Your money is making you more money, and then that money is making you even more money. This cycle continues, creating exponential growth. The longer you let your money compound, the more powerful it becomes. Time is your greatest ally in this process. Over time, those small gains snowball into massive returns. This is why starting early is so crucial. If you leave that initial $1,000 investment untouched for 30 years, earning an average annual return of 10%, it would be worth over $17,000. That's the power of compounding. Imagine if you consistently invested money every single month. The results can be even more impressive. Even just $100 or $200 a month, consistently invested over time, can add up to a life-changing sum of money. The key is consistency and patience. That's the magic of compounding. It's not about making huge investments, but about making regular, consistent contributions. It turns small, consistent contributions into significant wealth over time. The earlier you start, the more time your money has to grow. Let's see how starting early can amplify this effect. By beginning your investment journey at a young age, you can take full advantage of the compounding effect and set yourself up for a financially secure future. When it comes to compounding, time is your greatest ally. The magic of compounding lies in its ability to grow your money exponentially over time. The longer your money is invested, the more it can benefit from this powerful financial principle. The earlier you start investing, the more time your money has to grow and compound. This means that even small, regular investments can turn into substantial amounts over the years. Let's illustrate this with a real-life example. Imagine two individuals, Sarah and John, who decide to start investing at different points in their lives. Sarah starts investing $200 a month at age 20. She is diligent and consistent, making sure to invest the same amount every month without fail. John, on the other hand, waits until he's 35 to start investing the same amount. He realizes the importance of investing but starts 15 years later than Sarah. By the time Sarah reaches age 60, she'll have contributed $96,000. Her early start gives her a significant advantage. Thanks to compounding, her investment will have grown to over $700,000. This impressive growth is due to the power of compounding over a long period. John, starting later, will have only contributed $60,000. Despite investing the same amount monthly, his later start impacts his total contributions. His investment will be worth around $300,000. The difference in their final amounts is striking. That's a difference of over $400,000, all because Sarah started 15 years earlier. This example clearly shows the impact of starting early. The earlier you start, the more time your money has to grow exponentially. This exponential growth is the essence of compounding. Now, some of you might be thinking, I'm already past my 20s, is it too late for me to start investing? This is a common concern, but there's good news. Absolutely not. The second best time to plant a tree is today. It's never too late to start investing and take advantage of compounding. The sooner you start investing, the sooner you can harness the power of compounding. Don't wait, start today. Every day you delay is a missed opportunity for growth. Even if you're starting later, you can still benefit significantly from compounding. The key is to begin as soon as possible. The key is to start as soon as possible and stay consistent. regular, disciplined investing can still yield impressive results over time. Let's move on to the importance of consistency in investing. Consistency combined with time is a powerful combination. Consistency is crucial for unlocking the true potential of compounding. By staying the course and investing regularly, you can achieve your financial goals. We've talked about the importance of starting early, but consistency is equally crucial. Compounding thrives on regularity. The magic of compounding works best when you make it a habit to invest regularly, no matter how small the amount. It's not about making one big investment and hoping for the best. Instead, it's about creating a steady stream of contributions that can grow over time. It's about consistently putting money away, month after month, year after year. This disciplined approach ensures that you are always moving forward, even if the progress seems slow at times. Think of it like building a muscle. Just as you wouldn't expect to get fit by going to the gym once, you can't expect to build wealth with a single investment. You wouldn't expect to get ripped by going to the gym once. It takes regular workouts to see results. Investing is the same way. Regular, consistent contributions are what build a strong financial future. Consistently investing even small amounts is far more effective than making sporadic large contributions. This steady approach helps to smooth out the highs and lows of the market. Every contribution gives your money more fuel to compound. Over time, these small amounts can grow significantly. Automate your investments to ensure consistency. By setting up automatic transfers, you remove the temptation to skip a month. Set up automatic transfers from your checking account to your investment account every month. This way, you don't have to rely on willpower alone. Automating your investments is like putting your wealth building on autopilot. It ensures that your financial goals are always being worked towards. It ensures you never miss a contribution and takes the emotion out of investing. This way, you can focus on other aspects of your life, knowing your financial future is secure. Let's talk interest rates. Interest rates are like the engine that drives your growth. The higher the interest rate, the faster your money compounds. But higher returns often come with higher risks. Instead of chasing sky-high interest rates, focus on finding investments that offer a good balance of risk and return. The stock market, as measured by the S&P 500, has historically returned an average of around 7 to 10% per year. Consistent growth can turn a small investment into a significant nest egg over time. Remember, slow and steady wins the race. Let's discuss the importance of avoiding the temptation to withdraw your investments. Compounding works best when you leave your money alone to grow. It can be tempting to dip into your investments, but every withdrawal disrupts the compounding process. Think of it like training for a marathon. Taking a break sets you back and interrupts your progress. The same goes for your investments. Every time you withdraw money, you're interrupting the compounding process. You're sacrificing long-term growth for short-term gratification. Stay disciplined and avoid the temptation to withdraw. Let your investments grow uninterrupted. Now let's talk about some hidden obstacles to compounding inflation and taxes. Inflation and taxes can chip away at your compounding gains. Inflation is the rate at which prices for goods and services increase over time. It means the purchasing power of your money decreases as time goes on. Invest in assets that have a history of outpacing inflation, like stocks, real estate, and commodities. Taxes can also take a bite out of your investment returns. When you sell an investment for a profit, you'll typically owe capital gains taxes. Be aware of taxes and factor them into your overall investment strategy. Understanding these obstacles can help you mitigate their impact. Now, let's explore how compounding can go beyond money. Compounding can also be applied to other areas of your life, like skills, knowledge, and relationships. Compounding isn't just about money. The same principle can be applied to your skills, knowledge, and relationships. Every time you learn a new skill, you're making an investment in yourself. The more you practice and refine that skill, the more valuable it becomes. The same goes for knowledge. Every book you read, every podcast you listen to, every conversation you have, these are all opportunities to compound your knowledge. And let's not forget about relationships. The more you invest in relationships, the stronger they become. Strong relationships can open doors to new opportunities and support systems. Now, let's talk about some practical steps you can take today to start harnessing the power of compounding. Let's talk about some practical steps you can take today to get started. Step 1. Open a brokerage account. A brokerage account is your gateway to the world of investing. Step 2. Set up automatic contributions. Automating your investments ensures consistency. Step 3. Invest in diversified assets. Spread your investments across different asset classes to reduce risk. Step 4. Be patient and stay consistent. Compounding is a marathon, not a sprint. It takes time for small, consistent contributions to snowball into significant wealth. Don't get discouraged if you don't see massive returns overnight. Stay the course and let the power of compounding do its thing. Now let's wrap up with some final thoughts. Compounding is the bridge between where you are and where you want to be financially. Start today and take control of your financial